Hello investors, welcome to Business Learnings. In this video, I'll analyze IDFC First Bank. We'll go through its quarterly report, quarterly investor presentation that it has recently released. This bank is regarded as the next HDFC bank, the potential multibagger of this decade. We'll try to analyze what percentage of that claim is even valid. So by the end of this video, you'll have complete clarity on what's happening and what's next. So make sure that you watch the video throughout the end so that you get complete understanding, and do subscribe to the channel to support my work. We'll start with the management quality. Mr. V. Vaidyanathan, he probably one of the best banking leaders in India. The reason being, he's credited with the retail franchise growth of ICICI Bank, and we all know how strong ICICI Bank is today. And not just that, while leading Capital First Bank, he grew the loan book, the retail loan book from just 100 crore rupees to 30,000 crore rupees. 300 times growth in less than a decade, which is phenomenal. If he's able to bring that kind of growth in IDFC First Bank, the share will rocket in thousands, if not hundreds. So this is about the management. Now let's just quickly look at the numbers that it has reported. The capital adequacy ratio is 14.33%, slight improvement from previous quarter. This number is important because it tells you how strong the bank is in very basic terms. Lower the number, bigger the probability of the bank going bankrupt. Take it as this. For Kotak Bank, for HDFC Bank, this number is more than 20%, and that's why there is a pain point. This is the only bothering number that I find in this entire investor presentation. But we hope that this number will keep on improving because we believe in the able leadership of Mr. V. Vaidyanathan. Now let's look at the another very important number, which is net interest margin. Banks accept deposits, right? And when they get a lot of money with those deposits, they lend out that money to people who need money, right? And they charge interest on them. That's how the banks make money. The difference between the interest charged to the people who have borrowed money and the interest that's provided to the depositors, this difference is net interest margin in very simple terms, and this number is increasing. It is about 4.65%, which is probably in the leagues of Kotak Bank and HDFC Bank, and that's why a very good number, if you ask me. And they are even we aspire to take this to 5 to 5.5% in the next 5 years, which is, if it can get to those numbers, it will be phenomenal, unprecedented in the banking industry. So again, a great positive thing. I'll quickly show you the next important thing. The concentration of top 20 depositors as percentage of total consumer deposits has been decreasing. So about 40% of their deposit books was due to the top 20 depositors, and this is problematic because this means that each depositor was contributing about 2%. Imagine if any one of these depositors take out their money, the bank's liabilities will drop immediately by 2%, and that's problematic because bank needs money to run its business. It needs money to lend out people, and that's why this concentration has to be reduced. The top 20 and now the top 20 players, the top 20 depositors, they are just having the percentage just 10%, and this number is decreasing. You mean just top 20 players just comprise of 10%, each of them about 0.5%, which means on an average terms, which is a good thing, because even if one of them takes out their money, the bank's liabilities will just go down by 0.5%. Again, a similar kind of number will be seen in the loan book also, and I'll quickly show you that number. But before that, see the growth in CASA ratio. CASA ratio is 48.31%. This ratio should be as high as possible. The reason being, it's very cheap to maintain CASA ratio. CASA means current and savings account, and the banks just have to pay 4, 5, 6% interest to maintain CASA ratios. CASA is important because that's how a bank can raise money to lend out to other people, right? Banks can also raise money from different other methods, raising equity, raising equity capital, or probably certificate of deposits, or various other debentures, various other methods. And most of them, for IDFC First Bank, most of them are expensive. The CASA is the cheapest way, and that's why increasing CASA ratio is very important, and the bank is very much on the right path there. Now let me show you the most important thing. I'll talk about the NPAs in a while, but let me show you the most important thing why I very much like this bank. I like this bank because it has consistently bringing down the wholesale exposure. You see, the loan book is 1.1 lakh crore rupees in March 19, and currently it's again 1.1 lakh crore rupees. In about 2 years, the loan book didn't grow at all. What grew is the percentage of retail deposits, the percentage of retail loans, which is about 60%. It used to be it used to be 90%, and now it's 60%. It used to be just 10%, and now it's 60%. The fraction of retail loans should be as high as possible. The reason being, even if one of your corporate loans they default, you have a big dent on your balance sheet. The reason being, corporate loans they run in thousands of crore rupees. Even if one of them goes down, it's a huge impact. While even if some of the retail loans go bad, it doesn't matter. People like you and me, we do not default. We diligently pay our EMIs. uh, the one who default, we all know who defaults. It's all over the news all the time. We all know the big corporates. uh, we all know what happened with Yes Bank. Uh, the big 90% of its loan book was in corporate, and most of them defaulted, and uh, the shares are now just 5% of what they used to be. We all know what happened there. So this is very important, and this is what IDFC First Bank is doing right, and that's why I see a very good growth. And not just that, the people, the retail people, the unbanked people in India, their number are surprisingly high. If you go to the villages, these people, they are still paying 40-50%, up to 40-50% interest rates to the unorganized lenders, to sahukars. And imagine if all those peoples could be connected by a bank, all those peoples could be lent out money, they'll easily, happily accept to pay 20-25%, because they are paying double, triple than that. And that's where the market growth lies, and that's where IDFC First Bank, in my opinion, is headed towards. They have established their brand in most of the countries, especially with the collaboration with KBC, Konbaya Crorepati. They have reached out to most of the households in India. And not just that, they are even offering 7% interest rate, which they have reduced to 6%. But they have the growth in CASA accounts, the growth in retail loan books is phenomenal, and that's what the growth engine for the next decade is going to be for this bank, and that's why I'm very positive on it. Now let's talk about one last number that we missed out here. It was on the net interest margin, I believe. I cannot find it in the slide, but I'll just talk about it. The net interest, I think I already talked about that number. So yes, the net NPAs and gross NPAs. So these are the numbers which tell you what percentage of loans are going bad. So if you have lent out 100 crore rupees of loans and 2% gross NPA, means about 2 crore worth of loan is going back, it's not coming back. And this number should be under control. Now, as per the orders of Supreme Court, a lot of banks are not disclosing these numbers, the COVID related provisions they are disclosing, but they are not allowed to disclose the entire GNPA or net NPA until and unless they are advised to do so further by Supreme Court. But still, the banks do provide some guidance. See, the gross and net NPAs would have been 3.88% and 2.35%. Big number, but again manageable because of a decent capital adequacy ratio. I will say it's not problematic at all. And given that the bank has said that it will keep on dropping in So you see it's keep on dropping. It does uh, it's actually dropping throughout the quarters, throughout the previous quarters, and that's a very good thing. And if COVID-related provisions were not there, it would have been about 4.18%, 2.04%. But the thing is, bank management has already guided that these numbers will already be in control in the next 3-4 quarters. So I'm not very much worried about that. So two worry points: the capital adequacy ratio and the COVID-related provisions, which once declared by all the banks, will try to analyze what impact can it have. But in terms of the management quality, in terms of growth prospects, we see a very big upside. There might be some volatility in these stocks until everything COVID is settled out, until all all the things which are not clear, they become clear in the next few quarters. Then it will be probably a very good time to invest in. Again, disclosure that I'm not a SEBI registered investment advisor, so please do your own research uh, before investing in the stock. And so yes, this was my analysis. Please go through this document, the investor presentation. You'll get more idea, you'll get more in-depth um, analysis, understanding of the company. And you should always be understanding the business that the company is going to the company is providing. So I hope you liked the video. Please do subscribe. Thanks a lot if you have been watching this.